Silver didn't collapse because demand vanished. Paper prices are falling while physical metal is disappearing. This isn't volatility. It's a structural failure unfolding in real time. This channel tracks what's happening beneath the surface: physical metals, paper market stress, and the forces reshaping the global financial system. Welcome back. I'm genuinely glad you're here, because what's unfolding in the silver market right now is not speculation, and it's not short-term noise. What we're watching is a structural event, one that exposes how fragile the system has quietly become. And the speed at which it's accelerating is catching almost everyone off guard. Over the past several weeks, a global shift has been taking shape under the surface. What began as a political backlash has now reached the core infrastructure of the silver market itself. European dock workers are refusing to unload shipments bound for the United States. At the same time, reports continue to surface that influential executives and institutions are quietly reducing exposure to the U.S. financial system. There are no press conferences, no announcements, just silent capital movement, which is often the most important kind. Here's the critical point most people are missing. Silver did not collapse because demand vanished. It collapsed because access to supply is becoming uncertain. And banks know it. On Friday, silver briefly traded near $122 before plunging toward the mid-80s in what can only be described as a forced liquidation event. The spark was political, but the mechanics were financial. The unexpected nomination of Kevin Warsh to lead the Federal Reserve triggered one of the most aggressive dollar rebounds in years. The DXY surged violently, and that move ripped through leveraged positions across the commodity complex. Silver, being one of the most leveraged markets globally, absorbed the shock first and hardest. This was not a natural repricing. It was a setup. Sharp price drops like this are designed to provoke fear, flush weak holders, and push physical metal back into circulation before markets reopen. Because when trading resumes, paper silver and physical silver are headed toward a confrontation. And when that happens, the quoted price may no longer reflect reality. Across Asia, particularly in China and South Korea, consumer behavior is shifting rapidly. This isn't about tariffs anymore. It's about economic separation. Trade flows are being redirected. Alliances are being reconsidered. Strategic materials are being treated as national priorities. And silver sits directly in the middle of that transition. The result is a paradox that should not exist in a healthy market. Paper prices are falling, while physical demand is surging. In basic economics, scarcity drives prices higher. But silver is no longer operating under basic economics. What's being traded on screens around the world is not metal, it's exposure. The majority of global silver trading consists of contracts, derivatives, and ledger entries. Institutions like the COMEX and the LBMA dominate price discovery. Yet both function on a fractional reserve model. For every physical ounce held in vaults, dozens of paper claims are issued. This system only survives as long as most participants never ask for delivery, exactly like a bank. But that assumption is now breaking. Supply chains that feed physical silver into the system are fracturing. European ports are blocking shipments. Asian buyers are prioritizing stockpiles over manufacturing inputs. And when physical metal stops flowing freely, the system doesn't reprice smoothly, it seizes. What follows is a liquidity failure. Paper contracts are dumped at any price to meet margin calls. Physical silver vanishes behind rapidly expanding premiums. What used to be a few dollars over spot is now $15, $20, even $30 in some regions. In others, there is no quoted price at all, because there is no inventory. This brings us to a mechanism most retail investors never think about until it's deployed against them. Margin control. The CME Group, which oversees COMEX trading, has the authority to raise margin requirements without warning. On Friday, silver margins were increased by nearly 50%. In practical terms, anyone holding leveraged positions suddenly needed dramatically more capital, immediately. Those who couldn't meet the requirement were liquidated automatically. Ask yourself who that hurts. Large bullion banks are never caught unprepared. Retail traders are. Thursday's crash removed the weakest positions. Friday's margin hike was designed to deepen the liquidation. Not to discover price, but to manage risk for institutions that are dangerously exposed. Because beneath all of this lies a reality few are willing to confront. Major banks are deeply short silver. They have sold metal they do not own. They rely on abundant supply and low delivery demand to close positions later at lower prices. That strategy collapses the moment physical delivery becomes scarce. When delivery pressure rises, the rules change. Emergency margin hikes appear. Contract terms are adjusted. What was marketed as a free market begins to behave like a control mechanism. And this is unfolding as the United States implements the highest broad-based tariffs since the mid-20th century. Policies that fuel inflation and weaken confidence in currency itself. Historically, when trust in fiat systems erodes, capital seeks refuge in tangible assets. Now widen the lens. We are watching multiple forces converge at once. Economic blockades, a paper-silver market operating far beyond physical capacity, emergency measures to protect institutional shorts, global policies that undermine dollar confidence. Any one of these would be historic. Together, they represent something far more serious. When Asian markets open, the question won't be whether silver trades at $80 or $120. The question will be whether price discovery still functions at all. This is no longer about forecasting price direction. It's about whether silver splits permanently into two markets, one for paper exposure, one for physical metal. And if that divide becomes permanent, the number on your screen becomes secondary to a single question. Do you own metal, or do you own a promise? The next 48 hours could determine whether the largest silver exchange in the world remains credible. So let's remove emotion and look strictly at the structure. COMEX inventory is divided into eligible and registered silver. Only registered silver is deliverable. Currently, registered inventory stands near 30 million ounces. Meanwhile, March delivery obligations exceed 500 million ounces. That's roughly a 20-to-1 imbalance. If just a fraction of contract holders demand delivery, the math fails instantly. The exchange is then left with only three options: source metal that isn't available, force cash settlement, declare force majeure. And the most important detail is this: these risks are already known. That's why margin requirements were raised. That's why pressure is being applied now, before delivery deadlines arrive. Beyond silver, the global system itself is shifting. The European Union has activated mechanisms to reduce dollar dependence. BRICS nations are settling trade through a new unit reportedly backed by gold. Saudi Arabia has accepted it for energy transactions. When global trade no longer requires dollars, excess reserves seek alternative stores of value. Institutional interest in precious metals is rising sharply. Central bank gold purchases are near multi-decade highs. Silver lease rates have spiked, signaling tight supply. Settlement delays are being acknowledged quietly, not publicly. These are stress fractures, all pointing to the same fault line. If delivery failures become visible, physical premiums will surge. Inventory will be withheld. Private price discovery will replace public exchange pricing. At that point, paper silver becomes irrelevant to anyone who needs real metal. Price targets don't matter when supply disappears. This is the real decision facing investors. Remain tied to systems that can be diluted and restructured, or hold assets that exist outside the promise layer entirely. Silver has survived as money for thousands of years. The modern fiat system has existed for a few decades. History has already shown which one endures. When markets reopen, we'll find out whether this structure holds, or whether we are witnessing the early stages of a permanent reset in how precious metals are valued. This isn't fear, it's awareness. And right now, awareness may be the most valuable asset of all.